We're here at the Precious Metals Investment Symposium in Melbourne. We're pleased to have Mr. David Morgan here with us. Mr. Morgan is the founder of the Precious Metals newsletter, The Morgan Report, and he's also the author of several popular books covering silver and the silver investment. David, thank you for joining us today.
My pleasure, thank you.
Now, to start off with, you've previously stated that silver is one of the most undervalued metals today. What makes it undervalued? And what are some triggers for the upcoming price appreciation that you forecasted before?
Well, it's undervalued from the aspect of, like any commodity, if you can see the price of it less than what it takes to actually get it, or obtain it, then you're buying it at a discount to the wholesale price. So for example, if you can buy wheat under the value of what a farmer can produce a wheat crop for, the wheat is going to eventually either not be grown or it's going to achieve a price where a farmer can sustain a living. So silver's no different. If you can mine it at $17 an ounce and buy it at 14, you've now become one of the most productive silver mines in the world. So anytime you can buy a commodity under the cost of production, the true cost, the all-in sustaining cost, not the cash cost, which is actually a misnomer about the true cost, then, and have some patience, you'll probably make money. So that's number one. And why is it there is your question, and the answer to that's rather complicated. But like all markets that are traded in the futures industry, there's a supply and demand that is out of whack, which means because of the paper derivatives, there is an abundance of supply that doesn't really exist in the physical market. And because of that reality, then there is no real upper limit to what the supply is in theoretical paper derivatives. So there's an infinite supply of silver from the aspect of a derivative where the physical market doesn't, maintain that. Now the question then becomes, well, if that's true, and it is, then why doesn't the price of silver skyrocket up? And the answer is because there's enough at the margin, means what's physically used by the iPhone, the auto industry, the electronics industry, the solar industry, and net investment demand to meet it. If it wasn't being met, then the physical market would have much more influence on the price. It's that simple.
Okay. In your opinion, what would be the average all-in sustaining cost taken to mine silver at this point in time?
It's roughly $17 an ounce. I mean, each mine is an individual entity and it has a different all-in sustaining cost. I mean, you take Tahoe Resources and it's about 11. Okay. So you take a lot of other companies that have really worked hard to get their all-in sustaining costs down. I forget First Majestic's actual number. It's less than 17, I know that. But you got to remember that's with oil at about a $50 level. And the ratio to oil is about 25%, which means that if oil doubled in price to, let's say, 100 for an example, the all-in sustaining cost for First Majestic, Tahoe Resources, Pan American Silver, any of the majors would be significantly higher because they can't control the price of oil. Now, they might have hedged it, which would be a different story, but that's the point I'm making. So right now, the all-in sustaining cost is slightly above most of the best run silver mines in the world.
And that's really interesting that you pointed out because over the past 3 years, silver's kind of been trading in that range between $17 to $18.
Right.
Now, what do you think is keeping it there and what's preventing it from, let's say, breaking out?
Well, if you look at the Commitment of Traders report, there's basically a bandwidth. And when it gets to the top of the open interest and up into the, let's say, the 1850 range, and you can't do it so much on price, although you can, you'll see that there is a markdown. There's a markup. The shorts in the market just come in and pile on more and more as the price rises, and then the funds are out of money, so they can't go long any more metal. So if we're in a poker game and I see you're out of chips, and I hold all the chips because I have an infinite supply, I see you're out, I can just push a bunch of chips over there, and if I win that hand, then I take all your chips. And that game's played over and over again, so that's been going on for the last 3 years, basically.
Okay. Now, if we look at our current world, where there's like instant and cross-border transactions, how do you view silver's role as a monetary asset? Do you view silver as a medium of exchange in addition to perhaps a store of value?
Well, silver's historic role is actually more monetary than gold, believe it or not, but that's the past and now is now. So roughly 50% of the market is industrial, and the other 50% is between investment demand, and then you can put in other uses that silver takes. But I would say that it's still a monetary metal, but not nearly to the degree that gold is. But it will be monetary demand that drives the price higher, because even though industrial is about 50% of the market, it's the margin that moves the market. So when there's more demand for investors to own it due to a trust factor primarily, that they don't trust the currency that they're in, primarily the US dollar, but it could be trust of the Australian dollar or the renminbi or any currency, then you'll see a flood into gold, and that will spill over into silver, and silver's a much smaller market. So you'll see the silver price actually outperform the gold price in percentage terms.
Right, right. Now, the price of precious metals, as we know, is dictated by the paper markets, whether it's on COMEX or whether it's on London OTC. In your opinion, how does this affect price discovery, and is this sustainable?
Well, it's been sustainable as long as the margin we talked about before, I should say the net float, I'll call it, like in a stock, is able to meet the physical demand, and it's been true. Now, in 2008, during the financial crisis, there wasn't a silver shortage, but there was a silver retail product shortage.
Yes.
And that was a fact, and it's easy to prove it. The problem was that a lot of the silver bulls got overexcited, some anyway, that was a silver shortage. Unfortunately, it really wasn't. You could, in fact, I arbed it. I bought physical 1,000-ounce commercial bars off of the exchange at roughly $9 an ounce. So 3 of them were 27,000.
And the premiums didn't jump on those, right?
No.
Yeah.
And then the premium on a minted
Eagle
round was like $13 or something. So you could mint them at 9 and plus the cost, so say 10, and then sell them at 13, which is a pretty good margin. Of course, it didn't last very long, because anytime you can arb anything, even in a minuscule amount, the market usually closes and the arbitrage opportunity ceases to exist.
Do you foresee a time where, let's say, even the premiums on physical commercial bars would jump up?
Yeah, I think there will be a silver shortage at some point, and that's going to be a double whammy, because a lot of the industrial uses for silver are price inelastic. Small gold, Lewis makes a good argument that there'll be substitution or whatever, but really, and in some cases he's correct. And I'm only bringing up his name because he does some really good work, and I like learning from others. But when you have a refrigerator and it costs $3,000, and the amount of silver in it costs 10, if the silver goes tenfold, it costs $100. Are you going to substitute copper? No, you're going to use silver. And it's insignificant relative to the total price of it. So that's called price inelastic on the demand side. And most silver applications are actually in that position. So I don't buy the argument that if the silver price goes high, what will happen because of investment demand is industrial demand will panic. And they'll have to go into the market and buy it because they can't make a refrigerator without some silver. Excuse me.
Yeah.
So it will be a double whammy, because you have investment demand fueled by a panicked industrial user that needs to have the silver or they're out of business. So you have those two demands driving the price even higher.
Okay. Now, what we're talking a lot about is kind of physical silver right now. And I know you're good friends with our precious metals analyst, Mr. Koos Jansen, who tracks the physical flow of gold. But physical silver is arguably harder to track.
Much harder.
Yeah. So what are some key data points that you look at personally?
Well, one is that 70% of the silver supply is a result of base metal mining. So you've got 25% from copper, 35% from lead and zinc, and then you've got even like 10 to 13% coming out of gold. So you factor that, all those, and you look at where most of the concentrate goes through China. So when China is smelting lead and they're getting a bitch of silver out of it, or taking the copper concentrate and taking the silver out. So you really don't know how much is going in. I mean, you can guess it, but you don't know how much is staying in there, right? And how much is coming back out. So it's really hard to put a handle on it. I mean, you can get a guess of it, but where is it flowing? Much more difficult. It's like hiding gold in another element or something, and then not knowing what the ratio is, how it was smelted out, and how much exists. Only the smelter knows that, and that's in China.
And there's no official data.
There's no data coming out.
Okay.
So you figure it out. When Cruz figures it out,
I'll let you know. Okay, you've been covering the trend that the different countries are no longer interested in the US bond market as they have been historically. And the slack so far has been taken up by private investors. Now, is the role of the US dollar as the world's reserve currency coming to an end, firstly? And do you think that people at some point in time will start to reject the US dollar?
Well, it's ending. And I would say that, you know, as you alluded to factually, that, you know, China has offed a great deal of their long-term bonds, but they still hold a pretty good supply of dollars. Most transactions still take place in the dollar, but yet you have the AIIB Bank, Asia Infrastructure Investment Bank, and they have, you know, circumvented the dollar, circumvented the SWIFT system. I mean, the cryptocurrencies are all basically philosophically the same, which means that they all circumvent the SWIFT system, or the normal settlement system through the banking establishment. And so the dollar really is on the demise and will continue to do so. Will it end totally? And the answer is probably not. Like any hyperinflation, and I'm not saying we're having one, let's say it a different way. Any ultimate destruction of a paper currency ends as something else is coming to the fore. Very few go to absolute zero. The ones that go to absolute zero, there's a substitute. In the book Silver Manifesto, I forget how many there were, something like 30 or 40 since like 1990. And the reason no one knows about all these small countries whose currency basically went to zero is because they used physical U.S. cotton or paper as a substitute. So substitute for the dollar, that's a tougher one. Is it going to be a blockchain? Is it going to be gold? What's it going to be? Well, the answer probably is both. But yeah, I think it's in our future.
So you don't think it's just one thing that would trigger everything else? You think it's a mix of factors?
Well, it'll be more an emotional event than an economic event. What it basically boils down to is that there becomes enough people that mistrust the future of what the purchasing power of the currency will be to move out. And it doesn't take 100% vote. It takes a 1 or 2% vote. Because the markets in gold and silver, then the confidence starts to spread, and then similar to the blockchain or Bitcoin right now, where you get this parabolic move, that'll take place, except being not restricted to a great many people that are familiar with the blockchain, but hardly pervasive. It's pervasive worldwide once there's a panic in currencies. So it will be a bigger market.
Now that's interesting. What do you make of China building platforms for trading physical gold through the Shanghai Gold Exchange, and also now oil trading in yuan?
Well, I think the oil platform is very important. I've written about that. And of course, the physical gold market is extremely important for the really price discovery on gold. With all the paper that's out there, it'd be nice to have a cash-only market, but I don't think that will come. It certainly won't come voluntarily. It could come after a big reset. I doubt it, but it's hard to tell. I mean, it's trying to know the unknown and how this reset is actually going to take place. I think the banks are smart enough to have a plan A, B, and C, but it could go to plan D. I don't know.
Okay. I mean, a trend that we've been seeing in gold is, of course, the flow from the west to the east. We touched on this a little bit earlier in the interview, where, of course, China is a huge consumer of silver. But is it the same when it comes to investment demand for silver? Is there a flow from west to the east?
Not really. I mean, other than the smelter thing that we talked about, and silver is probably, China's probably the #1 producer of silver, even though they're not listed that way by CPM Group or GFMS. And I'm not going to argue, they're one or two. I mean, they produce a lot, and they probably use a lot, but they don't really say it. I mean, if you go back, I don't know the exact year, but roughly 10 years ago, silver was net export of China about 100 million ounces a year. And you go to like 6 years ago onward to the present day, they were a net importer of 100 million ounces a year. That's a net shift of 200 million ounces a year. So obviously, as they become more and more modernized, more electronic oriented, more cell phones, electricity, all the stuff that we enjoy as a technological society, China's going to demand more and more silver. So they're very, very, I wouldn't say secretive, but they're very closed-mouthed about silver. I mean, when I was there in Beijing years ago, They were primarily worried about the recycling of it. They didn't want to waste any silver, any way, shape, or form. They were very much aware of its value, not in dollar terms, but its value as a functioning part of a modern society, if that makes sense.
Yeah, yeah.
And then pretty close-mouthed about where they're going to, at that time, they're going to build a silver research center that the Silver Institute was speaking about, and I was really kind of excited about that because they did it in the rare earth element space, which the Morgan report was kind of one of the first on that story. But regardless, coming back to silver, we never saw that materialize.
Right. But I mean, given these factors that you just brought up, I mean, it seems that the government has some interest, definitely, in the investment demand of it. Yeah.
Well, they do. I brought it up to them, and they kind of laughed it off somewhat. But there is not as big a demand for silver for the average person in China as there is for gold. Right. There is some, and it's growing. And I think with the internet and everything else, it's possible that it will once that market goes, because the Chinese are no different than any other human being. When the market's exciting, it gets exciting for humans in general.
Yep.
And maybe I'm misstating this, but the Chinese seem to be bigger risk takers as a race, and I mean that as a compliment, than maybe some other nationalities. But regardless of my viewpoint, being politically incorrect, I think China could be maybe the driver, if you want to break it down. But once the panic goes, and there's panic buying, it's going to be across the board. It's a human emotion.
Absolutely. I mean, so to wrap up, some precious metals investors have been disappointed with the relatively slow price action of silver over the past few years. What advice would you give investors in the precious metals space considering jumping ship? And what advice would you give to new investors looking to get into the precious metal space?
Well, new investors is easy. I mean, as I said at the beginning of the interview, if you could buy a commodity under the price of production or close to it, just buy it with some patience. And I think today you wouldn't have to wait too long. I think 2018 will be a good market for the precious metals. 2019 will start to accelerate and probably have a blow off sometime in 2020, 2021. That's my current view, subject to change. As far as people that have held on this far, hold on a little longer from what I just said, because I think it's not imminent, but it's close. I mean, you're not going to have to wait 6 more years. Maybe 6 more months, maybe a year and 6 months. I don't know for certain, but you don't have to wait much longer. So I think that covers both the worn out bulls. You got to remember, we had a 10-year market in silver and about 11-year bull market in gold. People forget that. Every year, price was higher, price was higher, price was higher. The shares were doing better and better. Some weren't, but most were. Look at the XAU or the HUI. I mean, it's good times. And then when it peaked, and very few had the guts to call the peak, I did. I called it almost to the day. I warned my people that, probably have a 2-year bear market. Well, it was like a 5 or 6 year bear market, and that's hard to take. A lot of people gave up. But now we're at the end of that. There's a lot of indicators that we're putting together at this conference and what I do in my weekly updates for the public for free, that the market bottomed at the end of 2015, and we had a great 2016. We've had kind of consolidation here this year, and then we're ready to move up further.
Okay, great. Thank you so much. Thank you, David. It was a pleasure having you.
My pleasure. Thank you.